Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks and European futures slump on a surprise hawkish turn by the Fed after its latest rate cut. Officials reining in their forecasts for next year's rate reductions.
As for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
The Bank of Japan holds as attention turns to Governor Ueda's press conference with the yen under pressure. Meanwhile, the Bank of England expected to hold rates later today amid stagflation fears. Plus, a US government shutdown looms again. President-elect Donald Trump opposing a stopgap budget bill, urging lawmakers to raise the debt ceiling. So a hawkish cut from the Federal Reserve, a reining in of those expectations around rate cuts to come through in 2025 from 4 to 2, wrong-footing the markets yesterday. The S&P having its worst Fed day since 2001, stocks falling around 3%, yields higher around 10 basis points on the US 10-year. The focus shifting from the labour market of September to inflation again, a new dynamic into 2025 from this Federal Reserve. European futures then looking to drop around 1.6%. European stocks flagged by these futures. FTSE 100 futures also pointing lower by a full percentage point as we lead up to the Bank of England's decision, fully expected by the markets to stay on hold. S&P futures then currently flat after the losses of yesterday. Nasdaq 100 futures currently pointing to losses of 0.2%. Let's flip the board and look cross-asset then. The focus on the Treasury yield curve. Relatively benign picture in the session today, but the rout was there yesterday. As I said, the 10-year yield shooting high, the highest level now since and in about 7 months. 452 being yielded on your benchmark 10-year. The pound in focus ahead of the BOE decision, currently at 125. You saw pressure coming through on strong dollar yesterday, of course, as well. Brent 72.95, currently down 0.6% on oil. The growth concerns will be front and centre as well in terms of the demand picture. Bitcoin having crossed above 108,000, currently at 101, just up 0.3% so far for the largest crypto space. Cryptocurrency in that space, and worth noting as well, EM currencies are being crushed on the back of strong dollar. On that note, let's cross over and check in on the Asian markets. Avril Hong standing by in Singapore. Avril, what a day.
Yeah, Asia stocks and currencies are really getting hard hit today. No thanks to a hawkish Fed. Let's talk about stocks first. The region's benchmark hitting the lowest level since September. All the sectors deep in negative territory. And tech is the drag today. We're seeing that pressure coming through on the Japanese benchmark as well on the day where the BOJ left rates unchanged was as expected. I'll talk a bit more about that in just a bit. But look at how the Chinese assets are also coming under pressure. This is an added concern, right? Given how the investor confidence has already been rattled, given what we're seeing in the domestic economy, then the threat of tariffs. What it doesn't need is a hawkish Federal Reserve. Let's flip the board and take a closer look at what we're seeing in FX, because that is also where you're seeing the bleed as far as the rupee is concerned. It's hit the lowest level ever. Korean won lowest since 2009. Of course, it's a bit of a double whammy given the political concerns in the country. It's also forced the hand of sorts of the PBOC to support the Chinese currency via the yuan, fixed strongest versus estimates since July. So it's going to be really interesting to see how the Fed sort of forces these Asia central banks into defense mode, whether it's going to be via the interest rates or intervention in the currency markets. Of course, it's also just complicated things for the BOJ. It's really going to be about Ueda. He has to communicate to the markets they're serious about tightening. Otherwise, it's going to, come at the expense of the Japanese yen, Tom.
Yeah, and we listen into that press conference in about 25 minutes' time. Avril Hong in Singapore, the Indian rupee at the lowest level on record. Let's get back to the Japan story, though, because the yen has weakened, of course, as Avril was saying, as the Bank of Japan keeps rates on hold. That was the decision earlier today. Traders are now shifting their attention to that press conference from the governor to see whether a January hike is on the cards. For more, let's bring in Bloomberg's Paul Jackson in Tokyo. Paul, What an interesting day, an interesting dilemma, arguably, as they lead up to January for the BOJ, with one eye surely on the Federal Reserve. What is the likelihood right now that they've held, of course, in this decision? What is the likelihood they go in January?
I think there's a strong likelihood that they will go in January. I think following the Fed's hawkish cut, what we got was a hawkish hold. We had the leading hawk on the board, Tamura, suggesting that they should raise rates in December. Obviously, that got voted down. But I think that's a hint that something's in the works. Of course, to cement that, we have to look out for some more signals. And as we get nearer the actual January meeting itself, I think there were a number of reasons for holding off today. You've got a lot of political uncertainty domestically. You've got a minority government trying to get through a budget, and we've seen how minority governments trying to get budgets through can cause a lot of headaches across the world. Just look at France and South Korea recently. Given these facts, I think that the sense that there was no urgency to move has switched the focus to January. So we have the hold today, and now we're going to be looking for any hints that might come from this Ueda press conference.
OK, scrutinising any hints from the governor as they look now to January, and markets try to assess the next moves from this BOJ, given the hold today, with politics in focus as well, interestingly. Paul Jackson in Tokyo with the details and analysis. Thank you, Paul, for the context. To the Fed then, of course, and you can't unpick the two. The Fed has lowered its benchmark interest rate for a third consecutive time, but cautioned over how quickly it can continue reducing borrowing costs next year.
The committee decided to lower the target range for the federal funds rate by a 0.25 percentage point. Committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. To cut further after this point, I would say it this way. We've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
OK, Fed Chair Jay Powell, of course, speaking there after that decision. Let's bring in Bloomberg Markets reporter Valerie Teitel. Valerie, what specifically was it that Jay Powell said that so unnerved these markets?
Look, Tom, we knew we were going to hear a cautious Powell, but we really didn't realize we were going to get a cautious Powell so much. They only showed projections in their dot plot for 2 cuts for next year. And he followed that up with saying that today's rate decision was a closer rate decision than previous, that we did get a dissent on the decision from one voter, but the dot plot shows that she was joined by 3 others, meaning nearly 20% of the FOMC had their hands raised for a Fed to pause their interest rate cycle yesterday. We also saw in the SEP that a good chunk of the members saw inflation risks as now weighted to the upside, and Powell claimed that he's now seeing a new phase of the cycle, that is Fed speak for a Fed on pause as we go into next year. Let's flip on and talk a little bit more about the dot plot, because not only did we get that one dissenter, she was joined by 4 others. Also, when it comes to 2025, there was one FOMC member who did not see a cut for next year. It was this hawkish message that really did rattle the market.
Talk to us about the market reaction then yesterday, because it was pronounced.
It was pronounced, especially in the equity market. It was one of the worst post-Fed sessions for the S&P 500 that we have seen in some time, down nearly 3%. It was also a shocking move in the dollar. We saw a big bout of dollar strength, which is even more surprising, Tom, because the market is already long dollars. So to see the dollar move higher by another percent after this decision was very surprising to the market. We also saw that reaction in EM that you talked about out. The Brazilian real hit fresh lows versus the dollar, and the Indian rupee just a few hours ago as well. What is also surprising is the reaction that we saw in the interest rate market. Not only did we see yields rise around 10, 11 basis points across the curve, but if we look at what the market is now pricing for the Fed for 2025, we are now only pricing in just one Fed cut from the Federal Reserve for next year.
Okay, yeah, markets are only confident of just one cut next year from this Fed, and that is rippling across these global markets as we speak, and of course tying in to the expectations around other central banks globally as well. Valerie Teitel, thank you very much indeed for breaking that down for us, and that ties into what to think about for the rest of the day. 8:30 a.m. UK time, we get the Riksbank rate decision, so our focus there on Sweden. At 9 a.m. UK time, the Norges Bank rate decision follows as well out of Norway, and at 12 p.m. UK time, it is the BOE rate decision, expected, of course, the Central Bank of the UK to be on hold. Stagflation concerns here in the UK with a little bit of growth, but inflation remaining sticky, particularly when it comes to services. Now to the US, where President-elect Donald Trump says he opposes a proposed government funding bill threatening a stopgap measure that would keep the government open until mid-March. Opening trade anchor Kriti Gupta joins me now for more on this. What is Trump? Seems to come out of nowhere to some extent. They'd agreed this bill, Republicans and Democrats, tie things over until March. Yeah. Then Trump intervenes. What is he looking for?
So there was already a federal government shutdown on the cards for this week. It was supposed to kick in on Friday at midnight. And I kind of feel like the Republicans, Democrats had created some sort of bipartisan agreement. Some of that included provisions for something like an NFL stadium that got moved to Washington, D.C. Some really intricate kind of nuances in this bill. But the all-clear sign was very much lit until Elon Musk, Vivek Ramaswamy, the two, of course, expected heads of the Department of Government Efficiency that Donald Trump is creating, and Donald Trump himself, they're against the stopgap bill and have suddenly married the stopgap bill, which would have extended funding from basically the end of this week into mid-March approximately, and tied it to the debt ceiling. And here's where it gets tricky, because the debt ceiling is something that kicks in 10 days before Donald Trump gets inaugurated on January 10th. And the way around it, basically, is that the Treasury Department has to extend and use extraordinary measures to extend the funding and go anywhere from 3 to 8 months. And that means that you can go from January and hit that debt ceiling, but not actually suffer the consequences of a default until as late as July, because the Treasury Secretary can basically deploy these extraordinary measures. The problem is the Treasury Secretary changes 10 days after that. So Janet Yellen really only has 20 days to deploy these measures, and then it's Scott Bessent's territory if he indeed is confirmed. And that's where it gets really, really tricky in terms of finding this kind of issue of whose turf does the debt ceiling get hit under. And that's where Donald Trump is saying if that's going to be an inevitability baked into the system, it should be under Biden's watch, not his watch, which is expected to happen. The other piece of this is he's also now tying it to the stopgap bill. And historically in Congress, every time a Republican comes out with a bill that Donald Trump doesn't like, he's kind of put on a little bit of a Trump naughty list, if you will. And that's the scare factor here, where you've gone from really bipartisan support for a bill to now it falling apart.
Yeah, I mean, he's been explicit, hasn't it? You will be primaried if you support this bill. And as well, you know, recent history, it's the Republicans who've been pushing back against raising the debt ceiling. And now Trump's saying raise the debt ceiling. So we're going to get our heads around that as well. Elon Musk posting a picture saying this is pork barrel politics, talking about the stopgap bill. Where do negotiations stand?
In a very, very tricky place, because so many people have kind of pivoted on what they were initially agreeing to. So I can't actually give you clarity on where they stand because nobody actually knows. But it has suddenly become something that the market has to pay attention to, where, as previously got an all-clear sign, that deadline hits Friday at midnight as well. And this is crucial because it also talks about the reputation of Mike Johnson, a Speaker of the House. We know several Speaker of the Houses, Republican Speaker of the Houses, have basically been ousted. Kevin McCarthy was a great example because they couldn't get a budget across the finish line. Now Mike Johnson, after lots of negotiations, has to prove that he's the man for the job.
Kriti Gupta, anchor of the Opening Trade. Thank you very much indeed on the negotiations and the fraught discussions taking place in Washington right now about funding that government and the market implications. Traders coming up. Traders are looking ahead, of course, to the Bank of England's rate decision amid stagflation, fears, more on what to expect, and particularly pushing out to 2025. The analysis is coming up. This is Bloomberg. Welcome back. Now, after decisions from the Fed and the BOJ, attention now turns to the Bank of England, expected to hold rates with fears of stagflation looming over the central bank of the UK. Inflation rising to an 8-month high in November, drifting further above the Bank of England's 2% target. For more, we're joined by Jackie Bowie, head of EMEA and managing partner at Chatham Financial. Jackie, good morning. Thank you for joining us. Talk to us about what you're going to be looking at when it comes to the BOE. Arguably, it's less about the decision today and more about how markets are starting to price into 2025. Where is your forecast at this point?
Yeah, so obviously expectations are for no move today for the Bank of England to hold. And again, if you think back to earlier this year, there was expectations we would see more rate cuts. They haven't come. So you're right, everyone would be focused on what the Bank of England say, looking forward to next year, kind of mirroring what the Fed said last night, so a slowing of rate cuts. I guess that might be in the mix somewhere. An expectation that it will be a unanimous vote by the Bank of England, which again, if you look back at previous meetings this year, it's been a bit more of a split. So they're definitely in a very difficult situation where inflation is not quite coming down to the target, starting to see some increases come through next year, but at the same time we're in a pretty weak growth position. So, looking out to next year, the market is still pricing in a couple of cuts from the Bank of England, but I think we'll really be looking at those commentary from today to see if that still sticks.
So 50, a little bit about 50 basis points, as you say, about two 25 basis point cuts being priced in by the markets. Bloomberg Economics thinks that you actually get a bit more than that you get to 3.75% by the end of the year, below 4%. Do you think we get below 4% on the benchmark for the BOE by the end of 2025?
I mean, I don't think it's outside the realms of possibility, but there's a lot of things that would have to happen, I think, for the Bank of England to get comfortable to get to that level. And we're talking about the headline rate of inflation. That's the one that the target is based on. But if you look behind the inflation numbers, if you look at core inflation and if you look at that services inflation, which is still sticking at 5%, combine that with the expectation of some of the private sector pay negotiations and increases that might come through next year, then I think you might end up in a situation where the Bank of England might be more concerned about inflation again.
So it's interesting. ING put out a note about a week ago saying that core services inflation has actually made some progress and is around 4.5% now, core. So if you strip out things like travel and rent, and they see it getting to 3% by the second quarter. I wonder if we are overthinking the headline stickiness in services. Are you seeing that progress when it comes to core?
Well, I guess you can look at the numbers and you look at what makes up from an underlying perspective, and then you can look at what's happening anecdotally. Yeah. And I think the one thing that we haven't seen, so of course services inflation, we're a services economy, so we look at the wages inside the services sector, and given what we've seen through the budget, now there's a lot of commentary as to whether those national insurance increases will really start to feed through. We have to wait and see, but certainly I think that's the risk, right, that we haven't really seen the impact. But it goes either way,
right? So they either firms put up prices to make up for the increase in national insurance costs, or they either lay off headcount or just reduce headcount or just don't add headcount. And so you have an impact on the jobs market.
Correct.
Or both. So the labour market could look a bit more vulnerable next year. And maybe that is something that isn't being priced at this point.
Yeah, and the labour market's an interesting one to focus on, because obviously that we look at, GDP growth, we look at inflation, we look at employment. And the challenge in the UK is unemployment is measured through the labour force survey. And you've covered this before, we talked about it before. The data is not reliable because the response rate in the survey is now so low. So the ONS are looking for different ways to collect that data. So that's one thing, don't hang your hat on the numbers. I think the second thing in UK employment situation is the level of economic inactivity. The numbers we saw earlier this week, we saw a number of some 20% of adults who are not in employment but not actively looking for employment.
Which is an incredible number.
I mean, statistic. It's like 9 million people.
So that does include students?
It does include students, but interestingly, if you break the numbers down, the age group between 19 to 34 not in education was the one that was growing the most. So a very concerning situation for productivity.
Is stagflation what we're looking at in the UK right now?
It certainly seems a risk, as I say, and I'm probably more concerned about the growth outlook. And I've seen some economists out with some fairly optimistic numbers for the UK. Again, I think a lot of things have to go right for that to happen. So let's see what the Bank of England say today.
OK, Jackie Bowie, thank you very much indeed. Chatham Financial, head of EMEA and managing partner, with a view around the BOE growth and the work that still needs to be done on inflation here in the UK. Coming up, annual bonuses at Barclays could rise by up to 20%. Good news for traders in that bank as expectations rise for rewards on Wall Street. Bonus bonanza maybe for some. We bring you that Bloomberg scoop. It's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. Bloomberg understands that Barclays is set to increase annual bonuses by as much as 20% after an improved year for traders and investment bankers. According to its annual report, bonuses at the bank fell 43% across the board last year. So a different turn of events for 2024. For more, let's bring in our finance reporter, Will Shaw, who worked on the story at Bloomberg Scoop. Will, what has Barclays done right to get to this point, and how does this year, in terms of the bonus pool, compare to previous years?
So basically, traders this year are looking for bonuses between 5% to 10% higher. Now, in equity markets, in equity capital markets and debt capital markets, they're looking at even better, potentially 10% to 20%. Now, if we look and compare that to last year, some bankers got absolutely nothing last year due to a dry spell in deal-making and capital markets activity. Across the bank, according to the 2023 annual report, bonuses were down 43%, and then the year before that, they were down about 8%. So we're looking at a really good year as far as the investment bank is concerned.
OK, so maybe some champagne corks popping towards the end of this year, first part of next year, possibly for some teams across Barclays. How well has the bank performed in general this year, Will?
So the CEO, and Venkat as he is known, has been pursuing this big cost-cutting drive. He's looking to cut about $2 billion in the coming years. There have been layoffs, but by Q3, things were starting to look good. Advising revenue was up more than double, and on traders in fixed income and equities, they also beat expectations. So he's gambled, and for now the signs look like things are paying off.
And I guess, Will, a question for many watching will be: is Barclays idiosyncratic, or is this a story more generally across Wall Street and investment banks in Europe that bonuses are going to be bigger this year? What are they looking like?
Yeah, so bankers on Wall Street will be hoping that this is not the exception to the rule. At the moment, it looks like perhaps they're right. So bankers in debt sales are looking at bonuses up perhaps about 24%, according to Options Group. Then Johnson Associates are particularly upbeat about debt capital markets. They reckon bonuses could be between 25% and 35%. So all in all, if this turns out to be correct, a good year.
Bloomberg's finance reporter Will Shaw with that scoop around bonuses for Barclays and what it could indicate about the broader bonus bump for some of these investment banks as we head towards year end. Will, thank you. Let's get back to these markets. A huge day, of course, as traders globally readjust to a surprisingly hawkish Fed. At least many were taken by surprise, and you saw that in the moves down for equities, down for treasuries, of course. Yields were up about 10 basis points on the benchmark 10-year, and the S&P having its worst Fed day since 2001 with a drop of around 3%. The ripple effects across Asia, as you can see, are being felt. European futures set for a challenging day. European stocks pointing lower by 1.6%. Coming up, a corporate story in Europe. VW nearing a deal potentially around a walkout from workers. We get the details. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks, European futures slump on a surprise hawkish turn by the Fed after its latest rate cut. Officials reining in their forecasts for next year's rate reductions.
As for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
The Bank of Japan holds as attention turns to Governor Ueda's press conference, which is getting underway right now, with the yen under pressure. Meanwhile, the Bank of England expected to hold rates later today amid stagflation fears. Plus, Volkswagen and Labour leaders move closer to a deal to restructure the embattled automaker without shuttering factories in Germany as European car sales slump. Hold on to your hats then across these markets. European futures pointing to a brutal session. Losses being lined up of around 1.6% after the hawkish turn by the Federal Reserve knocked the senses out of US markets yesterday. The S&P falling around 3%. The small caps being crushed. The dollar soaring. Yields up and treasuries were under pressure. Some of that is moderated in the session, but the sell-off in equities continues. European futures pointing lower by 1.6%. Here in the UK, the FTSE 100 futures pointing to losses of 92 points. The BOE expected to hold firm in terms of its rate decision later today. No press conference, no forecast from the BOE. We look ahead to 2025. US futures currently flat after dropping and having the worst day for the S&P, the worst Fed day since 2001. Nasdaq 100 futures currently pointing lower by 0.1%. Let's flip the board and have a look cross asset then. Markets only confident that you get one additional cut from the Fed next year. That's after Fed officials moderated their expectations for 4 cuts next year to 2, with one member suggesting that maybe you get none at all. 4.52 right now on the 10-year. The pound in focus at 125 ahead of the BOE, up 0.2%. But after the selling pressure of yesterday on strong dollar, Brent at $73 a barrel, down 0.3%. Bitcoin up 0.1%. But after losing some of those gains, it had crossed 108,000. And then the Fed came through and Bitcoin and riskier assets took a hit. Let's get more on that then, because treasuries did slump as traders reduced their expectations for rate cuts next year, as I mentioned, as the Fed revised its 2025 guidance, and quite significantly so. For more, let's bring in Bloomberg's executive editor for markets, Paul Dobson. Paul, talk to us about the market reaction to this. It seems like many investors were caught flat-footed.
Yeah, there was certainly an allergic reaction in the market there, Tom. Particularly the equity side or the riskier assets as well. And I think, while the market would have been expecting the Fed to cut, would have been expecting the Fed to lower expectations for how many more cuts it was going to do next year, what it really caught everybody's attention was the kind of pivot back to really focusing on inflation and worrying about it that Powell emphasized kind of repeatedly. And so that came through loud and clear. And the thing is, let's face it, if you look at the data, yes, inflation has been sticky and it has been on a downward path, but not very rapidly descending. And so the market is worried that if the Fed is using that as its signal again, and is already worried about it even before Trump, then that's going to encourage the central bank to keep those interest rates much higher than might otherwise be expected for much longer as well. And so therefore, that pushes up those bond yields, that weighs against equities and riskier assets, it supports the dollar, and so on and so forth, as we saw blowing through the markets.
Yeah, Paul, and if markets were caught off guard by this, and it seems certainly that they were, given the price action, now the markets, at least in terms of traders around treasuries and fixed income, seem to be taking a more hawkish turn even than the Fed. Talk to us about how markets are starting to price in 2025.
Yeah, so as you were saying, only one full cut priced in for the Fed. And that is a little bit sketchy and wobbly as well. And I think, one thing that Powell emphasized is he said some of the Fed members in their forecasts were already starting to think about what the new U.S. administration is going to look like. Some weren't, and some didn't say whether they were or they weren't. But there's scope, therefore, for a more sort of inflationary policy from Trump to really start to weigh on markets and impact further the thinking of those governing council members. And so that, all things being equal, would talk to even higher interest rates. So the market is thinking, well, what do we do now? Probably January is going to be that start of that pause. And how long does the Fed pause for? And there's a lot of talk about inertia, right? It's easier to keep on cutting if you're already cutting. And that's what we saw with this decision, even though you might already argue against it to a certain extent. But once they pause, if they stop in January, next meeting, do they cut? If they don't cut then as well, then maybe they're stuck on a plateau and they don't get much further. And then if inflation really does come back and they are stressing that they're anxious about that possibility, could there even be hikes towards the back end of next year again? And that's what we've seen sort of leading up to it a little bit, that debate about, could we see 5% yields on treasuries again, 6% yields on the 10-year? Could that be a possibility? That's what's weighing on traders' minds and making them a little bit more conservative or a little bit more concerned about those longer-term prospects.
Yeah, we had that T. Rowe Price view that maybe you get to 6% on the 10-year by next year. Let's talk about the impact on the BOJ. We're having some lines crossing right now from Governor Ueda, Paul. A couple of lines worth noting. Governor Ueda expects price trends to rise gradually. Uncertainties remain high for the economy and inflation. Monetary policy depends on economy and inflation, of course, stating the obvious on that fact. To raise rates if economic outlook is realised, and this is important, real rates remain at a very low level. To what extent did this more hawkish pivot from the Fed force the BOJ's hands? They held today, but does it force the hands of the BOJ given yen weakness when it comes to January?
Well, judging by what you just read out, Tom, doesn't seem like a good old BOJ, huh? Not to be rushed into any sort of a decision. You'd think with the yen already weakening through 155 before today's decision, or to 155 before today's decision, at least from the BOJ, the door was wide open if they wanted to raise interest rates again now. The impact on markets, especially the currency, would be unlikely to be that pronounced. They're waiting until they're absolutely certain that inflation is entrenched, that wage growth is going to continue in the Japanese economy. As long as they sit on their hands and don't give very strong signals that they are going to be hiking soon, the more markets assume this gradualist approach, the more markets will start to price in a weaker yen again relative to the US dollar in particular. And, if they don't move in January when there's so much opportunity and so much momentum and goodwill behind them and hold off even further, then, that could spell a whole bunch more yen weakness before we finally get to see some sort of stabilization and reversal on higher interest rates. So it's that kind of, get off the fence, guys. What are you waiting for? Do you really need to take your time, particularly when the Fed is, opening the door and holding it wide open for you?
Yeah, still seems like they're sitting on the fence, at least for now. We'll keep across, of course, these comments from Governor Ueda as that press conference continues. Bloomberg's executive editor for Asia Markets, Paul Dobson, excellent on the Fed and the BOJ around the context and analysis. Paul, thank you. Now to a corporate story, and a major one with ramifications, of course, across the European auto space. Bloomberg learning that VW and Labour leaders are moving closer to a deal to restructure the automaker's namesake brand without shuttering those factories in Germany. Let's get more from Bloomberg's Oliver Crook. Ollie, you've been following this very closely from day one. What is the latest?
Yeah, exactly. From day one, we're on round 5, day 4 of round 5 of negotiations between Volkswagen labor leaders and the management board, and really a sort of saga that has been stretching in for a couple of weeks, a couple of months now. And really a very first, we should remind people, for Volkswagen, which is basically had been talking about closing factories for the first time in its entire history, right? This absolute shock to the sort of manufacturing and industrial sector within Germany. What we understand now, though, is that there is potentially a route that can be sort of threaded by labor leaders, by management, in which actually no factories get closed. This is really a substantial departure from the initial sort of talks, the initial negotiating positions. And just to remind everybody what they were talking about closing potentially 3 factories in Germany. They were talking about wage freezes through 2026 and 10% pay cuts across the board for the Volkswagen brand. That was the sort of opening gambit. What we understand now is that they're potentially looking at not cutting any jobs, reinstating some of the job security guarantees, looking into the future if they can do some other fundamental restructuring, meaning cutting bonuses to workers. This is going to be one of the planks. Another is going to be sort of moving some of the model assembly and manufacturing from Germany to Mexico, and also shutting down some of the EV manufacturing at some of the plants here in Germany. It is sort of quite a distance. I think it's sort of interesting for Volkswagen to come out and talk about closing 3 factories, if that is something that they are potentially in their negotiations willing to not do. At a time, particularly when, Tom, of course, we got more European car data out today. Their sales were down 2%. We're talking about major mergers in this sector in Japan. We're talking about Volkswagen that has 10 brands, Stellantis 14 brands. So I think there's also potentially a risk of these car companies not going far enough and then having to renegotiate these things. But again, this is all sort of, according to people familiar, these negotiations are still very much live, but that is the latest in the state of play now for Volkswagen and management board.
Yeah, and we were just seeing pictures of that huge Wolfsburg production facility. Look, this is not just a VW story, as you know, Ollie, and you've been talking about this. This is a German story. This is a German economy story. And that's why there's the politics at play as well. And you've been talking to some of the key leaders when it comes to that election in Germany, and these issues are front and centre. Who have you been talking to? What's the latest?
Yeah, absolutely, Tom. I mean, front and center is the economic situation in Germany. And admittedly, you know, this is going to be a large part of why there's been so many problems politically in Germany. It's not just the sort of political story. It's an economic story, and it's a strained budget story, right? That is what brought down the government. A voice that I've been speaking to yesterday, and this is a voice that we do not get the opportunity to speak to very often, is the head of the AfD, Alice Weidel. She is the first ever chancellor candidate for the AfD. And the reason that they've put forward a chancellor candidate this time around is because they are carrying 20% of the vote in Germany. They are carrying 1/5. They are the number 2 party in Germany. They are sort of iced out by the political establishment in Germany. No one will work with them in coalition. That puts a huge limit on the amount of power that they will actually have in Germany. However, it gives them a lot of free rein to be intensely critical about both the German government, but also the sort of the EU. So I spoke to Alice Weidel, and really at the very beginning of our conversation, she made the auto sector a primary part. Have a listen.
We don't see that the European Union in its current state is an institution that is working well, right? So what we need to have is free trade among the European countries, but we don't need all the bureaucracy. So example, the European Commission, which is actually not voted, right? So you have a executive power like the Commission with also legislative power that is not elected. So this is a huge democratic deficit. So this Commission decided just to forbid diesel and benzene, like all the traditional fossil motor, right? So what happens is that they actually ripped off the German automotive sector.
Many people are critical of the EU on many of the points that you make here, but very few are making the case for withdrawal from the EU, and specifically on the euro. How do you envision that happening? Was it a return in Germany to the Deutschmark? Is it then? Explain to us the mechanics of how you imagine that working if you had your way.
Well, this is the entire discussion around the Dexit, right? Yeah. So we think that the European treaties need to be reformed so that every country within the European Union has a right, first of all, to have a veto against the Commission. For instance, that the German government could say, okay, we don't agree, we say no. Mm-hmm. So the veto power in the European treaties. And if a country wants to leave the European Union, why not falling automatically into a free trade zone? I highly recommend just a free trade zone, because all the bureaucrats, thousands of them, like eating up taxpayers' money, they just disturb real competition among the European countries. We don't need all of these bureaucrats that have actually who have no clue what they're doing and destroying our foundation in the European Union.
And so listen, Tom, I mean, these are sort of radical ideas as far as the markets and economists are concerned, right? There are a lot of people that are very critical of the EU, its inefficiencies, its bureaucracy, some of its issues, but very few people are talking about complete withdrawal of the basically main pillar of the European Union from the EU and from the euro. And by the way, these were positions that were once held by some of the other far-right parties across Europe. Marine Le Pen, she has put a huge amount of distance behind that. That is basically not on the table anymore, and that is in part what has made them more electable. What is interesting, Tom, is we're talking about basically the number 1 country of the EU, Germany, the pillar, the number 2 party in the polls, talking about withdrawal from the euro. And again, she will be blocked out of power. They will not be able to go into coalition. That will put a real limit on what she can do. But at the same time, this is something that people need to take seriously where I'm sitting here in Brussels, and really need to continue to renew the case and remind people what the euro is serving for the German government. Again, at a time when basically a lot of the prescriptions for solving Europe's problems is actually more unity, a more federalized sort of European Union, not less. And this is going to be an increasing sort of conversation from the sidelines in its most important player here in Germany.
Yeah, as you say, particularly given what 20% of the German population appears to align with that anti-European view. Oliver Crook from Brussels with that important interview, and of course the details around what we're hearing from VW, and the two tie in together. Ollie, thank you very much indeed. Now, some other stories making news this Thursday. Germany, sticking with that country, appears to be pressuring UniCredit to sell its stake in Commerzbank just hours after the Italian lender increased its holdings. A deputy government spokesman said the investment is a, quote, pure investment that could be dissolved at any time. UniCredit announced yesterday that it had used derivatives to increase its stake to 28%, pushing it close to the 30% threshold that would trigger a full takeover bid. The chief strategy officer for Honhai's EV arm is in talks with Nissan shareholder Renault on its willingness to sell its shares in Nissan. That's according to Taiwan's central news agency, citing unidentified people in the industry. Honda is also in talks to form a potential merger with Nissan, which would create the world's third largest car maker. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back. The press conference for Governor Ueda over at the Bank of Japan is continuing, and his lines seem to be moving. Japanese yen lower against the US dollar, as you can see. Dollar up versus the Japanese yen, 0.7%. You're already through that 155 line that is seen by many traders as crucial in terms of potentially triggering rhetorical intervention from the finance ministry. Let's bring in Valerie Teitel, then, our markets reporter, for what we've been hearing from the governor and what it tells us about expectations going forward for the BOJ after they stood pat. What have you understood from these comments, Val?
Look, Ueda is talking about things that are happening in the spring. He's talking about wage negotiations that happen in the spring. He's not reflecting any sense of urgency of immediate data making them change their policy path for January. Remember, the market was very much focused on will they or will they not go in January, and he's definitely not speaking anything urgent to that matter. We were looking for some hints in this press conference that maybe they had their eye on something more near term. But if he's talking about something that's going on in the spring, Tom, that's a very dovish hint from Ueda. We're seeing that happen in the FX market, getting very close to the 156 handle on dollar yen. He also did talk about the impact of U.S. policies. This is something he warned on in the last press conference. He says he wants to see the impact from U.S. policies. He's warning that it could have a major impact on Japan. We're not going to get a clear picture from that in January. The Bank of Japan meets 4 days after Inauguration Day, when markets could be a bit unstable, a bit unhinged if we do get big economic announcements from the Trump administration.
And it's really fascinating because we're starting now to see these central banks having to really consider the policy agenda of the Trump administration, having previously said, look, we don't know, we're going to have to wait for it. We saw that with the Federal Reserve officials yesterday. We're seeing it from the BOJ now, as you say. He also said in terms of why they held this time today, lack of wage info was one reason why we held rates. We're looking now at closing in on 156 for dollar Japanese yen. To the extent the Fed forces the hand of the BOJ going forward, given that rate differential, Valerie, is this a BOJ that's going to have to walk things back in the early part of next year?
Look, see, we just got a new fresh line from Ueda saying he needs details of the Trump tariffs before they can analyze the impact. It's very much maybe the same kind of line we heard from the Fed yesterday. They do need to see details of the new Trump policies, the new Trump tariffs, before reacting. The question is, when do we get a clear picture of that, Tom? Because there are definitely some out there there who say even if we do get the tariffs announced, having them implemented and then knowing the economic impact, knowing the impact on the dollar, knowing the impact on treasuries might be for a few months' time. So he's very much pushing out the boat from what we're hearing from him. 155.93 on the dollar yen, 7/10 weaker on the session because of these comments from Ueda. Again, you noted the spring wage negotiations. They need more data on the wage negotiations. We don't really get a clear picture of that until the end of March. So that could be two Bank of Japan meetings from now.
Okay, Valerie Teitel, markets reporter, of course, on what we've been hearing from the BOJ. Thank you very much indeed. And, of course, tying in expectations around Trump policy and how the BOJ is having to factor that in as well. There's plenty more coming up. We're going to break down some of the renewed expectations and forecasts, of course, around the Federal Reserve and the brutal impact on EM. That's coming up. This is Bloomberg. Welcome back. So global markets still readjusting to this more hawkish Federal Reserve as they switch their focus from the jobs market to inflation as they fade their expectations around cuts for 2025. September, they had 4 cuts priced in on the dot plots. Now they have 2. Markets pricing in just 1 with confidence. So here's the picture for next year. 2's being priced in by these forecasts. 2026, another 2. 1 in 2027. Long-term rates settling at 3%. They don't think they're going to get to that inflation target of 2% until 2027. Let's flip the board and look at how markets then have been readjusting to this. Markets caught off foot, of course, off balance by what we heard from Jay Powell yesterday and the Fed officials' estimates. Now, front-running the Fed in terms of the hawkishness, markets now in terms of the pricing, just fully pricing in 30 basis points. So little over 1 cut, 25 basis points. They're pricing in 30 between now and the end of next year. They don't see rates getting below 4% until the end of next year, and markets now going a little bit too far in the other direction. That's part of the debate. Let's flip the board and have a look at how this is all impacting EM. You've seen the Indian rupee falling to its lowest level. But we're pulling out for you right now the Brazilian real. Yes, they're the idiosyncratic stories around the fiscal deficit, 10%, the challenges of getting that through Congress. They've watered down some of the proposals around this austerity package. That is certainly part of the question and the weakness that you've seen in the real. But Brazilian assets were amongst the worst hit yesterday on the back of this more hawkish Fed. You saw equities, so Brazilian stocks falling around 3% and further pressure on the real. Keep an eye on the bloodletting in EM on the back of what we're seeing around the Federal Reserve. Later today, we're going to be speaking with the US Secretary of State, Antony Blinken, about the Middle East as well as Ukraine. That is a crucial conversation. Don't miss it. The opening trade, though, is up next. This is Bloomberg.